In 1988, a bond trader named Larry Fink was forced out of First Boston. He had just lost $100 million in a single quarter because he didn't understand the risk in his portfolio. He was humiliated. He was finished. But in that failure, he saw the future. He realized that the era of the star trader, the cowboy screaming on the floor of the NYSE, was over. He realized that trying to beat the market was risky, volatile, and prone to human emotional error. He realized the real money wasn't in trading the assets. It was in gathering them. Today, that man controls over $10 trillion. His firm, along with one competitor, controls the voting rights for nearly every major corporation in America. His name is Larry Fink, the company is BlackRock, and the system he perfected, along with Vanguard, didn't just change Wall Street, it conquered it. We often talk about monopolies in the context of products. Standard Oil controlled the kerosene. AT&T controlled the phone lines. But what we are witnessing today is something far more profound. Rockefeller controlled 90% of the oil. BlackRock and Vanguard are the largest shareholders in 88% of the S&P 500. They didn't build a monopoly on oil, or tech, or banking. They built a monopoly on ownership itself. They are what economists call the universal owners. And just like the Rockefeller system, you cannot escape it because the system isn't a company. The system is the method. That method is passive investing. It has been sold to you as safety for 40 years. Don't try to beat the market, just buy the index. But in reality, that sales pitch facilitated the greatest consolidation of corporate power in human history. In this briefing, we are going to tear down the facade. If you want to stay ahead of these structural shifts and understand the machinery behind the market, make sure you are subscribed. We don't just follow the ticker here, we follow the power. Now, let me show you the Aladdin supercomputer that manages the world's risk, the shadow board that casts the votes for your shares, and why the index fund is just the modern version of the Rockefeller Trust. The architects and the machine. To understand the dominance, you have to look at the architecture. Rockefeller used a legal loophole called the trust to bypass laws against owning competitors in different states. BlackRock and Vanguard used a financial loophole called the ETF, Exchange Traded Fund. It started with a radical, benevolent idea by Vanguard founder Jack Bogle. His thesis was simple. Mathematically, most fund managers fail to beat the market average after fees. So, stop looking for the needle in the haystack. Just buy the haystack. It was cheap. It was efficient. It was framed as democratizing finance. And for the retail investor, it was a great deal. But then, Larry Fink added the weapon that weaponized this passive pool of money: technology. While Vanguard focused on the philosophy, BlackRock focused on the machinery. Fink built Aladdin, asset, liability, debt, and derivative investment network. Most people think BlackRock is just an asset manager. It isn't. BlackRock is a technology company. Aladdin is a risk management operating system. It monitors every stock, bond, and derivative trade for BlackRock. But it's not just for them. Who uses Aladdin? Vanguard uses it. Largest insurers in the world use it. Toyota uses it. Apple uses it to manage their treasury. Federal Reserve rents it to manage the U.S. financial system. By 2020, Aladdin was monitoring nearly $22 trillion in assets. That is equal to the GDP of the United States. This creates an information asymmetry that Rockefeller could only dream of. Rockefeller used secret railroad rebates to crush competitors because he knew their shipping costs. BlackRock knows the portfolio composition, the risk tolerance, and the liquidity needs of its own competitors because they are running their books on BlackRock's software. With this technological edge, they executed the modern version of the Cleveland Massacre. In 1872, Rockefeller slashed the price of kerosene to force competitors to sell to him. BlackRock and Vanguard used their scale to slash the expense ratio, the fee you pay to own a fund. They lowered the cost of investing to near zero. A standard active hedge fund charges 2 and 20, 2% fees, 20% of profits. An S&P 500 ETF charges 0.03%. Competitors couldn't survive. Active managers, stock pickers, and small mutual funds bled to death. The active industry saw outflows of trillions of dollars, while the passive giants saw inflows. The small funds had two choices: close down or get bought. By 2025, the result is a functional duopoly. BlackRock and Vanguard are the number one or number two shareholders in almost every public company you can name. They have effectively nationalized the stock market, but into private hands. The illusion of choice, the soft cartel. Rockefeller understood a fundamental truth of capitalism. Competition is a sin. Competition destroys profit margins. If two companies are fighting a price war, the consumer wins, but the owners lose. BlackRock and Vanguard solved this. You walk into a supermarket. You see Coke and Pepsi. You see branding wars. You see commercials where they attack each other. You think they are fighting for your dollar. They aren't. Look at the shareholder registry. Coca-Cola. Top shareholders are Berkshire Hathaway, Vanguard, BlackRock. PepsiCo. Top shareholders are Vanguard, BlackRock, State Street. Why would the owners want a price war? If Coke drops prices to steal share from Pepsi, profit margins at Coke go down. Pepsi responds by dropping prices, and their margins go down. If you own both, you lose money on both sides of the transaction. You don't want competition. You want stability. This phenomenon is called common ownership theory. Economists like Jose Azar have studied this extensively. They looked at the airline industry. When institutional ownership of United, Delta, and American Airlines converged into the same hands, ticket prices went up. Capacity growth slowed down. Why? Because the shareholders signaled, implicitly or explicitly, that they didn't want a market share war. They wanted margin discipline. This is the perfection of horizontal consolidation. Rockefeller had to buy his competitors to stop them from fighting. The asset managers simply bought the shares of all the competitors using your retirement money. They created a soft cartel. They don't need illegal backroom meetings to fix prices. That would be a violation of the Sherman Antitrust Act. They don't need to send emails saying, raise prices. All they have to do is hold the quarterly earnings calls. On these calls, the analysts from the big banks, who are also owned by BlackRock and Vanguard, ask the CEOs specific questions. Are you prioritizing volume, or are you prioritizing margin? Are you engaging in undisciplined capacity expansion? It is a coded language. The CEO knows who signs his paycheck. If a CEO decides to aggressively lower prices to help consumers but hurts industry margins, BlackRock has the votes to fire him. This effectively breaks the mechanism of capitalism. Capitalism relies on competitors trying to kill each other to provide the best product at the lowest price. Universal ownership incentivizes competitors to coexist to provide the highest stable yield for the shareholder. I'm curious if you've seen this in your daily life. Have you noticed prices for competing goods rising in perfect lockstep, whether it's airlines, food, or insurance? Let me know in the comments which industry you think is the most captured by this soft cartel. The enforcers, how control is exerted. You might be asking, I own the ETF. Don't I get a vote? No. You own the economic right to the profit. You do not hold the voting right. BlackRock holds the vote. But here is the logistical nightmare. BlackRock owns shares in over 17,000 companies globally. How do you research and vote on every director, every climate proposal, and every executive pay package for 17,000 companies? It's impossible for humans. So, they outsource the enforcement. Enter the proxy advisors. Institutional Shareholder Services, ISS, and Glass Lewis. These two companies control 97% of the proxy advisory market. They are the shadow court of the corporate world. They write the recommendations on how the big funds should vote. If ISS recommends voting no on a CEO's pay package, the algorithms at BlackRock and Vanguard often follow suit automatically, or robo-vote. This is the mechanism of control. This brings us to the most controversial tool in their arsenal, ESG, environmental, social, and governance. Regardless of your political stance on climate change or social justice, you must look at ESG through the lens of power dynamics, not morality. ESG is a compliance filter. It acts as a barrier to entry. BlackRock has been very clear. Larry Fink writes an annual letter to CEOs. In these letters, he dictates the terms. He states that companies must disclose their carbon footprints, their board diversity, and their social impact. Who can afford to hire the armies of consultants, lawyers, and auditors to produce these reports? ExxonMobil can. Volkswagen can. Microsecton can. Who cannot afford it? The mid-sized competitor trying to disrupt them. ESG acts as a regulatory moat. It raises the cost of doing business. By forcing expensive compliance standards on the entire market, the universal owners protect the incumbents they own from being disrupted by smaller, agile competitors. It is the exact same regulatory capture strategy Rockefeller used to keep new refineries out of the market. He demanded safety standards that only he could afford to implement. Furthermore, they control the cost of capital. If a company has a low ESG score, BlackRock may not buy their bonds. If BlackRock doesn't buy the bonds, the company has to pay a higher interest rate to borrow money. This is the ultimate leverage. They don't need to pass a law banning your business. They just have to make your money so expensive that you go bankrupt trying to compete. The Great Extraction, Housing and Inflation. So far, we've talked about stocks, but the universal owners are running out of room in the stock market. They have bought it all. Now, they are coming for the physical world. This brings us to the yield chase. For the last 15 years, interest rates were near zero. Bonds paid nothing. The pension funds that give BlackRock their money, the firemen, teachers, and police unions, need a 7% return to remain solvent. BlackRock couldn't get that in the bond market, so they turned to housing. We are seeing the institutionalization of the American home. Blackstone, a spin-off relative of BlackRock, Invitation Homes, and other institutional vehicles began buying single-family starter homes by the thousands. They have an unfair advantage. You, the individual, need a mortgage. You have to qualify. You pay 7% interest. The universal owners have access to nearly unlimited cheap capital. They make all-cash offers. You cannot compete. They are turning a generation of owners into renters. And this completes the cycle. 1. You work for a corporation owned by them. 2. Your retirement is managed by them for a fee. 3. To a landlord owned by them. It is a closed loop. And finally, they extract wealth through the mechanism of inflation. This is the Cantillon effect. When the Federal Reserve prints money, they don't drop it from helicopters. They inject it into the financial system by buying assets. Who do they buy from? They buy from the primary dealers and the asset managers. BlackRock manages the bailout vehicles. During the 2020 crisis, the Federal Reserve hired BlackRock to manage the corporate bond buying program. BlackRock was hired to buy bonds to save the market, including its own ETFs. They are closest to the money spigot. They get the fresh cash first, buying assets at today's prices. By the time that money circulates down to your wages, prices have risen. You get the inflation, they get the asset appreciation. The risks, the liquidity trap. But here's the hard truth, the same truth Rockefeller taught us. The system isn't evil in the cartoon sense. It is efficient. ETFs are cheap, they are easy, they perform better than most human traders. Just like Standard Oil dropped the price of kerosene from 58 cents to 8 cents, BlackRock dropped the cost of investing to near zero. The system delivers value, but it creates a massive, systemic risk that no one is talking about: the liquidity mismatch. Michael Burry, the man who predicted the 2008 housing crash, has called this the index fund bubble. Here is the problem: price discovery. In a normal market, buyers and sellers analyze a company to decide what it's worth. In a passive market, no one is analyzing anything. Money just flows in blindly. If you join the S&P 500, the algorithms must buy you, regardless of whether your company is actually making money. This inflates valuations artificially. But what happens when the flows reverse? Right now, the baby boomers are retiring. They are moving from net buyers of stocks to net sellers to pay for their retirement. If everyone tries to sell the index at the same time, who is on the other side? The active managers are gone. The market makers have been replaced by algorithms. If there are no buyers, the price doesn't just dip, it gaps down. The efficiency of the ETF structure works great on the way up, but it has never been truly tested in a prolonged structural liquidity crisis where the majority of the market is passive. We have built a market where everyone is a passenger and no one is driving. This is the exact type of systemic risk the mainstream financial media ignores but it is the signal we focus on here. If you value pattern recognition over market noise, subscribe and turn on notifications. You need to be prepared for when the liquidity shifts. The response and conclusion. So, what do? How do you respond to a system that owns the board, owns the bank, and owns the land? You have the same three options Rockefeller left us. Option 1. The passenger. Exerted. Buy the S&P 500. Pay your 0.03%. Accept that you are a passenger in an economy steered by Larry Fink. Enjoy the efficiency. Understand that your portfolio will do well as long as the liquidity flows. This is the path of least resistance. Option 2. The resistor. If you own shares, take them out of the street name. This is called direct registration, DRS. It removes the shares from the DTCC and puts them in your name. It removes BlackRock's ability to lend your shares out to short sellers or use your voting power. Vote your own proxies. Support local businesses that haven't been rolled up into the conglomerates. This is the moral path, but it is the hardest. Option 3. The realist. This is where I sit. If you cannot escape the system, you must position yourself to survive it. You must understand that in this system, capital is treated better than labor. Stop trying to win solely by working harder for a salary that is being debased. You must own the scarcity. The universal owners can print shares. The Fed can print dollars. They cannot print land. They cannot print gold. They cannot print Bitcoin. Rockefeller built a system that outlived him by a century. The asset managers have built a system that will likely outlive the dollar. The consolidation is inevitable. The soft cartel is the new reality of the global economy. You cannot stop the consolidation, but you can make sure you aren't the one being consolidated. This isn't investment advice. This is pattern recognition. Understanding the system is the first step. You cannot escape the universal owners, but you can see them. And once you see them, you realize the game isn't rigged. The game is simply owned. So, I have to ask, which path are you taking? Are you the passenger, the resistor, or the realist? Drop your strategy in the comments below. Play accordingly.